Word. Okay, sweet. Welcome to episode 38 of the Bearish podcast. We have Investing with Frank on. We've had Investing with Tom. We've had CJ Wilson. We've had Brad Kalner, and now we have Frank. It's funny, you guys all know each other. We did not plan that. We did not plan that to be this way, but it is what it is. Frank, thank you for joining me.
Yeah, thanks for having me on.
Yeah, Max and Logan are not here. They are doing soccer, whatever that is. Who cares? We want to talk about investing.
I'm the last punch card investing member to come on, am I?
You are
still missing a couple.
You are. Yeah, so let's just get right into it. Before I ask you any questions, Frank, just tell me and the audience a little bit who you are and how you got into investing.
Yeah, so I kind of came interested in investing during high school. So that's about 10 years ago now for me. But I really had very little understanding about it at the time. Then I went off to university here in Australia. I did a degree in teaching, but my major is business studies. So I kind of teach high school business and commerce and subjects like that. So a very small section of that is investing. Mm-hmm. And I kind of just got really interested in university. I kind of didn't think I would like subjects like accounting and finance and that, but I actually really loved it. So
me and you both, man.
Yeah. And I kind of got into some ETF investing very early on, not really knowing what I was doing, just knowing that was a nice, safe option. And then over the years, I kind of read more and more, come across people like Buffett, did the typical value investor readings, all the Benjamin Graham stuff. And here I am today. So yeah, it's worked out well.
Yeah. So, I mean, I know exactly what you're talking about with that. Never would I have ever thought that I'd be interested in accounting or any kind of math or anything like that. That was not what I enjoyed in school. So the first person that really sparked your interest in investing, was it Buffett?
Yeah, pretty much. So the first investing book I read was, I think it's called The Buffett Way or The Warren Buffett Way, something along those lines. And that was kind of my introduction, which was just by luck, really. First investing book I saw, I picked it up. I knew who Warren Buffett was, but didn't know why he was one of the richest men in the world. So I read the book, and I think I kind of got lucky to fall down that path rather than how a lot of other people end up in investing.
Yeah, with me, it's actually funny. A lot of people that do this value investing thing, a majority of them got into it by the same guy. And I want you to guess if you know who got me into investing or value investing as a whole.
Well, I would guess it's either Mohnish Pabrai or Warren Buffett. I don't know.
No, it's neither of them. It's Phil Town.
Yeah, true. That's another classic. Yeah.
I mean, it's a classic. Everyone that has like a value investing page, it's always Phil Town who got them into it. It's funny. It's funny how it works that way. So yeah, me, myself, I actually got into investing. I'm 21. I'm a senior in college. I got into investing in the late 2019, right before the market crash, perfect timing for me to get into investing. And all I was doing was buying, pharmaceutical companies, hoping they would skyrocket 100% in a day. And some of them did, most of them didn't. And then I actually, I learned the hard way. So I kept my money in. I didn't know anything, to be honest with you. I didn't know a thing. And then March rolled around, market tanked. Like now I realize I'm waiting for that now. I can't wait for that to happen now. Then I'm like, oh my God, get me out of this. I sold everything, most of it at a loss. And I didn't get back into the market until, Alibaba. That's pretty much until then. So, I wanted to ask you this, and I asked Brad this, and I want to compare your answers. How was last March for you? Did you buy? Did you sell everything, or I just want to know how it was for you.
Yeah, so a bit of context of what I was doing before March. I really started the portfolio I'm running now in March or April 2020. Beforehand, I had most of my money in index funds. So I had, for maybe 5 or 6 years, I was purely index funds. Then I started to try a little stock picking, like I was half in an index fund, half kind of just testing my luck with not too much analysis. I kind of learnt more and more as I was going on. And I was kind of waiting for the chance. I was getting to the point where I thought I might be able to do better than index investing, which might not be the case. I'm always happy to go back if I can't do that. But March just so happened I had about 30% of my portfolio in cash. And when the drop happened, I sold everything and started fresh, because by that point I knew that that's a good time to start a portfolio. So my returns have looked exceptional since then, but obviously that's the bias of buying at the lows.
Right.
But yeah, it kind of worked out really well for me. I just happened to have a large portion of cash, and I wanted to change my strategy. I wanted to get out of indexes and start stock picking. So that was the beginning of the portfolio and strategy that I'm running now.
Okay, so March worked out well for you.
It did. It was
At least it worked out
thing.
well. It worked out well for one of us. Brad, I believe, said that he didn't buy anything. I don't think he bought anything in March. In fact, I think he just held on for the ride. And actually, he said that he had 2 stocks on his watch list that got down to a certain price. It was Facebook and Uber, and he didn't buy either of them. He said it just went right back up too quickly, which it did. It did go up very quickly. You're a big fan of Twitter, aren't you?
I am.
You are amazing on Twitter. I have to tell you that. You are amazing on Twitter. Those threads, I read every single one of them. Those threads you put out, how much time goes into that, man?
I guess a typical thread where I'm writing like, I don't know, 12 tweets in the thread roughly takes me about an hour or so. It's kind of stuff that I already know. I've already been looking into. It's just putting it down in writing that's kind of logical. Most of the research I do isn't very logical or organized. So things like Twitter and YouTube actually have been really good for me, because I kind of just put it down in a couple of documents. Most of it's in my head, but now I'm starting to write things down, create videos, which really helps. So Twitter's been pretty good for that.
Yeah. And you own Twitter, right?
I do. I own the stock and I love the platform.
Oh my God. It's amazing, man. Brad said that if Twitter can create the value for its shareholders that it creates for its users, I mean, the sky's the limit for that stock. And I never even thought about owning Twitter. And then once he said that, I was like, man, Twitter, that might be a good investment one day. Not right now, or maybe I haven't done any kind of research on it, but Twitter's something to look for.
Yeah, so Twitter's not the type of stock I personally would usually buy. It was unprofitable. It's more of a growthy type name. It's kind of expensive using typical value metrics.
Yeah.
But when I was starting the portfolio, that was actually the first company I bought. I bought Twitter and Kelly Partners Group, which Kelly Partners Group has performed exceptionally well.
Yeah.
That's now almost half my portfolio. And then Twitter, I think it's about an 80 to 100% gain since I bought it as well. So that's done really well. But I kind of bought it with taking the advantage of the crash and that it was relatively cheap at the time. And compared to all those other social media platforms, it was exceptionally cheap.
Yeah.
And in my opinion, I'm certainly biased. I do think it's the best platform, and there's a lot of optionality of different ways they can monetize it going forward, which I think we're starting to see happen now. There was a couple of activists on the board making lots of changes and really making them focus on improvements of the company. And it's slowly playing out at the moment, probably not as quick as I'd like to see, but it's been good so far. So I think long-term, it's going to be a great company.
Yeah. I saw something about them accepting Bitcoin as like tips for their users. Is that what that was?
Yeah. So they have a thing called super followers as well, which is just, I guess it's going to take over like a maybe Patreon type platform.
Oh.
So you can just pay to follow people. But I think they also mentioned something about taking cryptocurrency or Bitcoin as payments as well, which doesn't appeal to me too much, but it is a nice added bonus. Like anything they're doing, if they're trying things, that's great. They're in the position where they can do that. So that's one thing that I liked about the company is all the optionality they have compared to something like Facebook that it really take advantage of everything and monetize everything really well. Twitter weren't doing that. So there's a lot of runway for growth moving forward.
Yeah. And you said earlier that Twitter's not a typical value stock, as you said. Like you can't really value it because they were unprofitable for so long. So that was a good segue into how do you personally value companies when you look at one?
That's a pretty hard question to answer. Every
Yeah.
time is different. Like,
Okay.
depending on the type of investment I'm making, typically I'm looking for long-term investments. I guess you could call them compounders.
Mm-hmm.
So high quality companies with high returns on invested capital that have the ability to do so for a very long time in the future, competitive advantages and moats and all those things. To value something like that, it's usually, I guess, a DCF type of valuation can work. But the simple way I think of it at first is how fast can the actual business grow, the intrinsic value of the business? So say I think that can grow at 10% per year. And then is there going to be multiple expansion? Is this very cheap compared to other similar businesses? If all other businesses that are pretty much the same trade at 10 times sales and it trades at 5 times sales, which was actually the case for Twitter, then I'm going to get some of my return from multiple expansion as well. And the other thing you can look at is a dividend yield. So they might pay a 1% dividend yield. So you add those three things together. And if that's over 15%, then that's kind of when I get interested and I'll move into more deep valuation from there. So what I just ran through then is called, it's by Shelby Davis, who's probably one of the best investors of all time, kind of unheard of, but has one of those like 50-year track records of outperforming the market. And that's how he valued his companies. So I kind of just taken that on board. I use that as a quick first step of valuation. And then depending on the type of business, you go from there, whether it's an asset play or something like that, you do it a bit different. If it is a compounder, you might do a DCF. So yeah, there's lots of different ways, but that's how I start thinking about it.
Okay. Yeah, that's a good idea. I just got into this. I've been into investing for, like I said, a little over a year now, but I just got into the valuing of companies, right? And I've really just, been doing the DCF and trying to, do stuff like that. But the comparison is a good idea. Is that what you said? Did you just compare them to similar businesses?
Yeah, I think you need to know what other similar businesses can trade for.
Yeah.
I'm trying to think of an example. Maybe something like an Alibaba, you could use the Western competitors to see what type of multiples they trade for. Obviously, with Alibaba being down so much in price at the moment, they're much lower. So you could make the assumption that maybe it could return to the multiples that the Western competitors have. If you're less bullish about China in general, which a lot of people are, you might take that down a notch. So if a competitor trades at, say, 20 times free cash flow, you might say Alibaba could trade at 18 times free cash flow or something like that. Those aren't the numbers they actually trade at, but that's an example of what I would do.
Yeah. Hey, well, you're doing my job for me very well, Frank. I'm going to talk to you about Alibaba now because what I like to do when I look at companies, and this isn't my only research, but I love going on Twitter and I love especially going on YouTube and looking at what people like you and Brad or Tom or, Hamish Hodder.
Yep.
Yeah. Him, New Money. What's his name? Brandon?
Yep.
Yeah. I love watching videos of what you guys have to say. And I love just hearing the points. So I just want to hear what if your opinion of Alibaba at all has changed, because they some big news just dropped this past week about they had to like get rid of their 5% stake in this media company. Not that that really means anything in terms of their business, because it really doesn't, in my opinion. But just give me, I guess, your thoughts on Alibaba and I guess what could change your opinion.
Yeah, so I'm probably the wrong person to ask. I am overly bullish on China in general.
Yeah,
I
same.
know obviously the market right now doesn't like China. That's shown in all the stock prices. They're really worried about the government and their regulations going forward. And being a communist country, it happens very fast. If they want to make changes to hurt their companies, it can happen overnight. Whereas the US government are trying to do the same thing with Facebook and Apple and everything else. They want to put these regulations in place, but it might take 5 or 10 years. In China, it happens very quickly.
Mm-hmm.
But overall, I don't think, like, I'm not overly pessimistic about China as a market or an economy. I think it's just as good or possibly better than the US. It's going to be a global superpower forever.
Mm-hmm.
Whether or not they're bigger than the US doesn't really matter. They're going to be 1 and 2 for probably ever. I can't see anyone else kind of stepping in there. So if you've liked the US market for the past 50 years, I think you should like China for the next 50 years.
Yeah.
So that's kind of my picture on the broader aspect of it. There is going to be these macro things that hurt you. There are going to be regulations that happen fast, but I'm trying not to worry about those too much. I just want to focus on the actual business. And the actual business is exceptional in my mind.
It is.
There's all these things getting taken away. So like Ant Financial was a fairly significant part of the business, I guess. Maybe you could say it was 5% of Alibaba's intrinsic value. And that's been hurt pretty bad by these regulations. So maybe now it's 1 or 2%. But overall, the rest of the business, the e-commerce platform is growing super fast. It's one of the best businesses in the world, a huge moat and competitive advantage that is not going away. The growth on that aspect might slow down, but then they have all these opportunities like cloud and everything else that can offer a very huge return. And if at some point the market decides it likes China again, then we'll see the stock price go up significantly. Yeah. That's the hope. I don't know if that will happen, but that's a nice upside if it does.
Yeah, we're both hoping that, Frank. We're both hoping that. When did you initially buy into Alibaba?
So about 3 months after Charlie Munger originally bought in, that was what piqued my interest. Like Charlie Munger doesn't buy a stock. It's the first he's bought in 10 years or something crazy. Yeah. So yeah, that started the research. And at first I was like, not my type of business. I usually like smaller microcap companies. So at first I was just like, I'll do the research. Why is Charlie buying? Was my mindset. I wasn't really looking into it thinking that I would buy it. But overall, I actually understood the business better than I thought I could. I thought it was a great opportunity. So I ended up buying in around $205 or $210 or something like that. So okay. I've been hit really hard. I'm down big on that one at the moment.
Have you averaged down at all?
Only very slightly. Okay. I think my average buying price is about 200. So
okay, yeah. Like you said, Munger doesn't buy anything. So when he buys something, you gotta, I mean, like you almost have to do some research. You know what I mean? Like,
of course.
All right, this dude bought something for the first time in a decade. Like maybe I should look into it. Yeah, my average buy price was around the same as yours. I believe it was 212. However, I've been averaging down. I think my average is about 162 now. So nice. I'm doing okay, but it's not something I really want to look at every single day. You know what I mean? I just get notifications on my phone from Fidelity, like, oh, Alibaba hit a 52-week low. And I'm like, okay, well, I guess I'll add in some. What do you think the cherry on top would be? If I was thinking about this when all the 13Fs were coming out, I was like, man, if Berkshire buys Alibaba, man, what would that do to the stock? I'm sure it would skyrocket it a little bit. You think he'll buy it?
I think he should,
yeah,
but
sure.
I don't think he will. Just the fact that Charlie Munger clearly understands the business and they work so closely together, I thought there actually might be a chance because Warren Buffett can really only invest in maybe 100 different companies around the world if he wants to make a sizable investment, just because of how much money. If he wants to put 10 billion towards a company and not own the whole thing,
yeah,
there's not many choices he has. And out of the choices he has, I think Alibaba seems the cheapest. Clearly, he doesn't have the same mindset as Charlie Munger. It would be like, we can assume he's looked at it. If Charlie's bought it, we assume that he has these conversations with Charlie. So for whatever reason, he does not want to take that risk. But yeah, I don't think he will, but I'd love to see it happen.
What do you think the reason is? Because when I didn't see him buy it, I was like, okay, because when those 13Fs came out, I saw Minesh Barai added 56%. I saw Guy Spear bought it. I saw Phil Town buy it. And I'm just thinking, what's keeping Warren from this? And I couldn't really come up with anything.
Probably the main reason is he is pretty adverse to investing in tech companies, even though he has nearly all his portfolio in Apple at the moment. So it's kind of counterintuitive, but he likes to stay away from those companies. And then he probably isn't as bullish on China as Charlie Munger is. Charlie Munger's been very close with Li Lu for a very long time. So he probably has a very different opinion of the economic system and political system in China. I could only guess that Warren Buffett doesn't share that opinion. There's been interviews like that recent one. I don't know where it was from, but the most recent Charlie Munger and Warren Buffett interview, Charlie kind of seemed very bullish, pushed out the China opinion, and Buffett was very quiet. So I just assume he's probably, doesn't want to take that risk with the Chinese economy and isn't as bullish about it all.
Yeah, that's all I can think of. I mean, I guess there's, risks in delisting and stuff like that I don't really think is gonna happen at all. Um, I think you have to be bullish on China, right? Like they're gonna overtake the US economy in not a few years, but in the future they will. Like 100%. And I wouldn't want to own any other Chinese company in my eyes. You could argue Tencent, I guess, but yeah, I'm good with Alibaba, right? You feel that way?
Well, I actually own Tencent as well. So
Yeah, you do. Well, what are you that's a good transition. What are you most bullish on? Alibaba or Tencent?
I talked about this in the Punch Card Investing live stream yesterday, actually. Unpopular to probably my audience and all the similar audiences on YouTube. I actually like Tencent a little bit more.
Oh, Frank, I don't own Tencent.
But I own 7 companies and those are 2 of them. So I'm clearly very, very bullish on both. But I do like Tencent a lot more. I like the gaming aspect of the business. It's just more interesting to me.
Yeah.
I also think they've diversified away from China a lot more than Alibaba has, which kind of takes away a little bit of the risk, although there's still a lot of risks involved in that one as well. But I think it can grow a little bit faster. And yeah, I don't know. I would slightly lean towards Tencent if I had to choose, but I like both businesses.
I'll give it to you. I'll give it to you. That's fine. That's fine. For me personally, I am bullish on China. I just don't want to be overexposed, if that makes sense.
Yeah, so, I'm the same way.
Yeah.
I kind of said to myself, I wouldn't want to go past 20% of my portfolio into China. I'm slightly over that, I think. And I'm not going to trim or anything, but I definitely don't want to add any more exposures to the region in the near future. Maybe if things smooth out, maybe long-term, there'll be a change in government or something that really makes it a much better environment to invest in. But I think 10 to 20% of a portfolio is probably all we should be thinking about in my mind.
Yeah, I agree. And I think that there will be a smoothing out period. I just think that they're going at it so hard right now and so quickly that it's just really freaking everybody out. But there's fear in the market. That's when you buy, right? That's what we've been told by the greatest investors ever. So yeah, speaking of China, this kind of goes into kind of, I asked Brad this. Would you ever want to run a fund? And I ask you this right after the China question, because I believe if I'm sitting here running a fund and I'm putting lots of money into China where it looks absolutely terrible right now, I'm guessing a lot of my investors would be probably, very angry at me and, like screaming at me, sending me emails. I probably get a little bit annoyed. So would you want to run a fund with just managing all these people's personalities and their opinions and their thoughts when you could just do it by yourself and not have to worry about anyone but you?
Personally, I probably wouldn't want to run a fund. I would love to be able to live off my own portfolio. If I had enough money to invest and kind of invest to live, that would be the dream. So I'm managing my own portfolio. I don't want to manage other people's money. I also don't think I would be as good of an investor if I had other people's money. I would certainly be more cautious. I would certainly, like you said, you'd have to stay away from things like China unless you want people to take money out of your fund, which is essentially a fund manager is more of a big part of their business is to be a salesperson. They have to convince other people to give them money and keep their money there. And that's not something I like to do. I like the analysis part of it. I like to stock pick. So I wouldn't mind a job along those lines, maybe like an investment analyst or something like that, some kind of researcher. But to actually own and manage a fund, I think would be a very stressful, unappealing career choice in my mind. Once you got to the level that a Moshe Brai or someone is, where they've got billions and they can kind of sit back and everyone trusts what they're doing, that would be okay. But realistically, I'm not going to get there. So being a small fund manager, I think would be a stressful, terrible job, but I do love it. I do love investing. So
yeah, it would be, I think it would be fun, but I think it sounds fun because I'm not doing it. Does that make sense?
Yeah. I agree.
Yeah. So yeah, I don't know. Maybe doing it by yourself is a little better. And you said so you wouldn't mind working with a firm or a fund, just doing some research and stuff like that?
Yeah, I wouldn't mind. I don't think it's something I'll actually end up doing.
Okay.
But yeah, I think that would be an okay job. Like I'm a
Good.
teacher at the moment, and that's not the best job. So I'd be
I
happy
think
to sit there and research all day and get paid for it.
yeah, right. Yeah, I wouldn't mind that either. I actually just applied for an internship at this firm, and the problem is I've applied to so many investment banks and stuff like that, like JP Morgan Chase and things like that, but most of them, almost all of them, don't implement these value investing principles, right? So I finally found this one called Harris Associates, and go on their website and it's all based on value investing. And I was like, oh my God, this is the dream right here. So I applied and we'll see how that goes. But I think that's a big problem with what we do, right? Because most firms and funds don't really, practice value investing.
Yeah, well, we're pretty much in a 5% minority. That's a number I heard Lulu throw out there. I don't know if there's statistical numbers to back that up, but we're definitely a minority when it comes to institutional investing a lot, at least anyway. So yeah, most funds are probably running a more growthy short-term strategy. And I guess that kind of is how you keep money in the fund, is you have these short-term targets, you can reach them, you can tell them next quarter, this is the results we expect, these are the companies we're buying. You can quickly turn over stocks if your investors don't like them. It doesn't hurt you to sell out. They're usually very diversified. So you can just sell out of a company to appeal to your investors. So yeah, it's definitely hard to find a good job in that field as well. That kind of aligns with your values.
Yeah, I agree. I wanted to play this game with you, and I don't know if it'd be much of a game because you might just take it over and go, solo. I wanted to do a little do's and don'ts of long-term investing or value investing, if you will, because there's a lot of people on YouTube that say they're long-term investors and they're absolutely not when you watch their videos. Like they're the exact opposite of that. So I just wanted to hear from you some do's and don'ts of long-term investing, so I can make a video of this and post it so people can hear from an actual value investor some do's and don'ts. So give me like 2 or 3 do's and don'ts of value investing.
If we're looking from a long-term framework, I guess, which is, I think, important for value investing, you're not going to realize value over a short term. There really is 2 different strategies. You can find like the 50-cent dollars in some kind of special situation, which is still value investing, but it is short-term focused. Every now and then I'm inclined to an idea around that. But for this example, I'll go with long-term value investing.
Okay.
So I think it's important to have a concentrated portfolio is probably the first thing. If you're diversified into, say, over 20 or 30 names, you're pretty much going to have market average returns. So you may as well go and invest in an index if you own over 30 stocks, in my opinion, unless, of course, you're very heavily weighted to your top 5 names or something like that.
So what's concentrated in your opinion? How many stocks is that?
I think a good range is probably 10 to 15 is a good range. The better you are, the lower that could go. Like if you can be a great investor with 5 stocks in your portfolio, that's probably the best thing to do. I'm slightly less risk adverse than that. I'm early on right now, so I actually only have 7, but ideally long term, around that 10 to 15 range is pretty ideal for me. Okay. So
yeah, that sounds like a good number.
Yeah, I think if you want to outperform the market, you have to be concentrated, and there's no doubt about that. If you're very diversified, you may as well buy an index. You're going to have market average returns, which is fine. That's great for most people. 99% of people probably should do that. But if you want to outperform, you definitely need to be concentrated. Another thing I think you need to do is look in markets all around the world. You need to be a global investor. If you focus in one market and that market's very expensive, you can't be a very good value investor. So you need to look for opportunities wherever you can. Certainly there's some places that you probably should avoid. Some people would say that's China, but I'd be leaning more towards things like Turkey or something where there's currency issues. I know Monish Pabrai invests there and he probably knows more than I do, but that's kind of where I draw the line, is these very fragile markets. But most countries that I can access, I think you should be looking for ideas. And that's also gives you an edge over most institutional investors. So I know most funds only look in the US. Sometimes they'll go into countries like the UK or Canada as well. But yeah, as retail investors, I think definitely you need to look around the world. And the other thing is you need to look at small illiquid companies. So micro cap and small cap companies. That's a big thing that I like to push. Just again, institutional investors can't invest in these companies. So they're more likely to be mispriced than a Facebook or a Google or an Apple, where there's thousands and thousands of Harvard-educated business analysts looking at the business. All these funds own it. It's probably fairly priced. Every now and then there could be a crash that gives you opportunities in those names, and that's fine. But really, if you want to outperform, you need to look at the companies that no one else is looking at, or where it's overly fearful at the time. So China's a pretty good example of that at the moment. Mm-hmm. So there's 3 do's and don'ts. Probably don't sell. Having a framework to actually hold on to your stocks forever is a pretty good idea in my mind. I don't follow that strictly, but I am a very reluctant seller. And that's definitely important as well, that long-term time horizon. Like we said, probably 95% of these funds are short-term focused, going quarter to quarter. So if you can focus on 5 and 10 years and longer, then you definitely have an advantage as well. So my don't would be don't sell unless absolutely necessary. Be a very reluctant seller.
Those are perfect. Although I'm going to challenge you on one of these. Okay.
Go for it.
What is this absolutely necessary selling rule? What would you consider absolutely necessary?
So you don't want to look at surface level valuation is the main thing, because a company could go from very cheap to expensive and stay expensive for a very long time. So if you're in, you may as well stay in my opinion. But if the business fundamentally changes and say what you liked about the business and what they were doing and what was going to lead to good returns and growth in the future, if that changes, then maybe you think about selling. Or if it's ridiculously, egregiously overvalued like a Tesla, that would be something I personally would sell out of at the moment. And if you bought into Tesla while it was cheap, good for you, that's fine. But that's to the point where valuation might make me sell. Otherwise, I guess if you're fully invested, so you've got $0 cash and you see a exceptional opportunity, then you need to take away your worst opportunity in your portfolio at the time. So if something's only offering you a 5 to 10% return, but you found this great opportunity where you're certain you can get 20% returns, then you could switch the money over like that. That would be reasonable as well. But even ideally, you would want to find the cash elsewhere before doing that if you can.
Yeah. Those are good rules. CJ said opportunity cost, like what you just said right there, which I think that's probably the easiest way to sell, to come up to with the decision to sell is, okay, maybe this thing's way overvalued. This thing right here is undervalued. Maybe I should trim this right here, sell it all and put it into that. Yeah, that's a good idea. I was going to ask you one more thing and I completely forgot. Damn. I'm gonna try to remember it, but I do want to ask you more about microcaps, because I know you are a big advocate for those, right? How I guess a good question for me as well as the audience is, what have you found to be the best way to find companies as a whole, but like smaller companies? What's the best way to find those?
This is probably not an answer most investors should say, but Twitter really has been the best way for me to source ideas. And it's more so meeting and talking to other small fund managers, other retail investors that have a similar strategy to me, and sharing ideas. Twitter just happens to be the space that a lot of people go to share those ideas. There's things like Value Investors Club and that as well, where some ideas go, but I don't know if I've ever made an investment from an idea in there. But often it's just networking. People you meet, I meet those people usually through Twitter. We share ideas, and that's often where a lot of them come up. 13Fs is another way for larger companies. You can idea source that way, which is fine. But more so, I like to look at smaller fund managers that are kind of earlier on in their career, have less money, run a similar strategy than as I do, and look at their holdings. That's probably one of the main ways I get ideas from. I do run screens every now and then, but I think only maybe one of my ideas have come from a screen. But yeah, they're probably the main ways, is just really networking and knowing people, and then looking at fund managers that have similar strategies to you and ideally don't have too much money, so they can invest in the same companies I want to invest in, and have a look at what they own too.
Yeah. Yeah. Sounds like the Twitter is the answer for everything, right? Twitter. It sounds like Twitter, you can pretty much do anything on with investing. Twitter and YouTube, man. What sites do you use to screen or to just do research on your companies? Because I saw someone put this on Twitter. Speaking of Twitter, someone put this on Twitter the other day. I think it was Brad. And he said, what sites, free sites, do you use to do some research? And I put Morningstar and Macro Trends. I don't know if you've heard, I'm sure you've heard of Morningstar, but have you heard of Macro Trends?
Yeah, every now and then it comes into my research a little bit. I don't go to it specifically, but sometimes I need to find information, and that's a decent place. Yeah.
So I'm just curious, what do you use?
The main thing I use probably for most of my surface level research, like when I first come across a ticker. Oh, there you go. The company's called Ticker, TIKR.
Okay, I've heard of that. Yeah.
Yeah, and it just has about 20 years of financial data. So it gives you a good outlook of how this company has performed for as long as it's existed or publicly traded, at least. Going back to 2004 is the earliest data they have on there. And to go through the financial statements over that long time period is just a great place to get started to kind of determine if you like this company. They also have things on there like what super investors own. They have like the other ownership, like how much the insiders own, all that type of information. They have valuation metrics. You can run easy comparisons. There's charts and things on there. It's pretty much everything you need to do your surface level research. And beyond there, then I think you're going to the investor relations page of the company and looking at their actual reports, 10Qs, 10Ks, and investor presentations and things like that.
Yeah.
But yeah, surface level, I spend most of my time on Ticker.
Ticker free?
It's free for now. I think they plan on charging towards the end of this year is what they originally said. It has been pushed back in the past, so I don't know what will happen.
Yeah.
But at the moment, all you need is a referral link and you can sign up for free.
How do you get one of these links, Frank? Because I feel like I need to get on Ticker.
Ticker.com/Frank.
Oh, all right. I'll do that.
But
Okay.
you could just Google search it. They're all through forums. Like, it's not hard to come by one.
I'm gonna use yours.
In my description, I don't make money from that. It is an affiliate. So in the future, when they charge, if you use my link and then you decide to pay, I would make a profit. But for now, that makes me no money.
Okay. Well, I'm going to use yours just in case you do make money. All right. How about that?
Thank you.
That's a thank you for joining the podcast. Yeah. Okay. Ticker. Yeah. That sounds good. 20 years of financial data. That's a lot. Or 15, you said?
Yeah. Back to 2004, if the company's been around that long.
Wow. That's crazy. Morningstar only, goes back just like Yahoo Finance or anything else. These go back, 10 years. All right, Frank, we're about done. I'm going to ask you one more question, and then we can talk off camera or off recording and for a little bit if you have time. Do you have time?
Yeah, easy.
Okay, cool. So my last question for you, Frank, is, and I can answer it too because I like playing this game.
Sweet.
I'll say give me, well, first of all, do you have a watch list? Because the last two people that we had on this podcast, I asked if they had a watch list and they both told me no, which I don't believe. Do you have a watch list?
Yeah, I've definitely got a watch list.
Okay, thank you.
I have two separate watch lists. I have a narrowed down 5 to 10 names that I really am interested in. And then I have another one of about 40 or 50 names that just kind of sit there and I don't do the work that I probably should be on that one.
Yeah. Okay. So we finally have a normal person on this podcast. Fantastic. Give me 3 to 5 stocks that you're most interested in, that you're just waiting for the price to be right. And you're buying in, just waiting for that price to be right.
So there are a couple that actually I think price is right at the moment. I'm kind of just waiting to have cash and to see what my best opportunity is.
Okay. And what are
Of course,
those?
so one is Hingham Institute for Savings, which is a small bank in the US. It operates mostly in Massachusetts. They have, I think it's 10 or 11 offices, and they're all in Massachusetts, except for one just started in Washington, D.C. Compared to other banks, all they focus on is real estate lending pretty much to both commercial and personal investors. So just housing essentially. And they've started in Washington, D.C. now because they think that's a similar market to Massachusetts. And then they also have like their bank deposits and stuff as well. But compared to a normal bank, it's pretty easy to understand because they really focus on three things. And they're a very efficient bank. Their expenses are much lower than any other bank that exists, pretty much in the top 1% of all banks for their efficiency ratio is what you'd look at for a bank. They have high returns on equity, and it's a great company with great management. That's definitely one I like, and there's a good chance I buy into that one in the future. I do want to see price come down slightly. They're trading slightly above their historical average, but I don't think it's expensive. I think it's fine at the moment. I would like to see it come down. Another one that maybe I'm not quite there on with research, but I like a lot so far is Automatic Bank Services, which is the ticker SHVA, I think it is. It trades in Israel. So a very obscure market that certainly has some risks. It's only a small market, I think 10 million or 9 million population even, but that's pretty much a MasterCard or Visa of Israel.
You just made a video about that, didn't you?
Yeah, just
I put that video on my watch later. I have to watch it.
So that's definitely one I'm interested in. They have all the same competitive advantages and moat that a MasterCard and Visa have. Okay. And they don't operate in Israel. Both MasterCard and Visa own 10% stakes in this company.
Oh, so, wow.
Yeah, that's a nice little one that I think will do well for a long time. And they trade exceptionally cheap compared to other larger companies that do the same thing. So if the market decides they like Israel at some point, that would do very well. Of course, there is some risks involved by investing in a microcap in Israel, but
what's it called again?
I'm interested in.
I'm going to put this one. I'm going to write this
Automatic Bank Services. The ticker's SHVA. Okay. Let's have a look. I'll actually pull my watch list up so I can give you another one. Those are two.
Yeah, give me some. Yeah, keep going.
Nintendo. Nintendo's a bigger company that I've been looking at, a non-microcap. That one's hard. It is a cyclical company at the moment.
Big time.
Just because of console sales, but they are starting to smooth that out with some recurring revenues from some of the software that they sell. So they're shifting away from being a cyclical company. They're starting into theme parks and stuff like that as well. So that's more recurring revenues as well. They're even going into the entertainment space. Their IP is insanely valuable. Things like Pokemon and Mario, all those things is just exceptional value that they can monetize in so many different ways. And then they have a huge cash pile at the moment that historically was a problem for them. They have like no debt and all this cash that they were doing nothing with for like the past 10 years. Yeah. So that's like the worst capital allocation decision ever, is to just sit cash there and do nothing.
Yeah, it is. Yeah.
But they've just started to kind of reinvest some of this cash and even buy back shares, which is rare for a Japanese company. They usually like to just pay dividend and pile cash because they went through this ridiculous period in the 80s, I think it was, or maybe 90s, huge inflation, and their stocks just crashed hard. So the managers over there like to hoard cash just in case of these occasions. So it makes it very safe. Like, I don't think you're going to get a poor result in any way. Maybe you don't get big returns, but you're not going to lose much money with a cash pile that big and a great brand. Yeah. So that's one that I see a pretty good upside coming from as well, assuming management can execute. But I would like to see that one get a little bit cheaper to make returns more appealing, but I do like the business a lot. So, well, there's three names anyway that I like a lot.
Okay. Yeah, I've been looking at Nintendo as well. The only thing that was throwing me off, and I haven't done my, due diligence. I haven't dug that deep into the company, but just looking at the stock price, over the last however many years, you can just tell like it goes up when they release the console, and then it just goes right back down to where it was. And then, just it's a lot of boom bust based on when they release their consoles, right? So what you said is they're gonna smooth that out. I think CJ said that they're gonna focus on the Switch for a little bit and then just do things with the Switch. Is that right?
Yeah, so I think they're going to try and think of the Switch as like an iPhone and really just improve the Switch over time, which definitely helps with cyclicality as well, if that was the case. I don't know if that's the best decision, but I don't understand enough to know how that would actually play out. But I think the best thing for recurring revenues will be the software and subscription type things that they're actually selling as well that can smooth it out. So you can still have somewhat of a cycle and go between consoles and have a bad console here and there and be okay as your subscriptions continue to grow. And then your things like theme parks and entertainment media that can get some extra revenue to kind of back up when you don't have a good console out and don't have that excess capital coming through.
Yeah. Nintendo's a good one. So are those the ones that you're most excited about getting to a certain price?
Yeah, those three. Another one is one that I used to own, VRQ Solutions. And I only sold out of that company to buy an engagement ring, of all things. So
well, that's a good reason, Frank.
Yeah, I couldn't use personal savings to do that. Of course, my partner would know that the money was missing. So I had to choose something in the portfolio. That was my lowest conviction idea at the time. So I sold out of that to buy a ring and added the rest into Alibaba at the time.
So that one got the short end of the stick, huh?
So that one's definitely right there. I just need to consider my options when I do have enough cash to buy a new position.
Okay. All right. I can give you I'll give you a couple. What do you consider a microcap, by the way? Or what's the universal definition of a microcap?
Most common would say under 300 million is a microcap.
So not under $1 billion.
Under $1 billion or under 2 billion, some people say would be a small cap. And I still love small caps too. Yeah.
Okay. Well, I have a small cap on my watch list. You might have heard of this company because I know they are in Australia as well. It's called Zoomies. And
is that like the skateboard shop?
Yeah, I think their Australian brand is Blue Tomato.
Yeah, that might be right.
Yeah. So I love all of their shirts. Odd Future. Have you heard of that?
Yep.
Yeah, Odd Future, Santa Cruz. They have a lot of Thrasher. They sell vans, like you said. They sell skateboards. I love that. I love that shop. And I know retail as a whole isn't expected to grow very much into the future. And if anything, there's going to be a big shift to e-commerce. But I think that they have their e-commerce down pretty well. And so that's one I'm interested in. Their market cap is $1 billion. So that would be considered a small cap, right?
Yep.
Okay. And then another one is a $6 billion company. It's Boston Beer. Have you heard of that?
I've heard. I don't know too much about it, but I have heard of the company. Yeah.
Well, they sell. Well, I don't know what the alcohol situation is over there in Australia, but they sell Samuel Adams, Truly, Hard Seltzer, Twisted Tea. Have you heard of any of those? No. Yeah, fair enough. It's an American brewery, anyways. But actually, funny thing. Well, not funny. It's kind of quite annoying, to be honest with you. They peaked at about $1,300 a couple months ago, and they've fallen all the way to $500. And in my estimates, they're so expensive still, and it just makes me so mad that they've took this dramatic drop. And I was so excited. I was like, oh my God, because I don't like I'm not the biggest fan of alcohol, but I know those brands well. And I know that those brands are killing it over here. So I just looked into the company a little bit and I was like, man, there's no chance this thing is still overvalued. And it absolutely is. It absolutely is. And it's so frustrating. And then another one that I would just love to buy is, this one's a good one. iRobot. You know what iRobot is?
No, I don't.
It's those
the movie with Will Smith, is that
it? yeah, that one. Yeah, I would love to buy stock in that. They sell automated vacuum cleaners. So you just press a button, they do it by themselves. They pretty much own the market apart from Shark. It's
Okay.
just another company, but their market cap is 2 billion. So I'm taking your advice in doing the smaller companies. Obviously, Facebook would be amazing to own. Twitter, if I could get another drop, I would love to buy. After talking to at least two of you telling me how great Twitter is, which I've come to my senses, and I know that it is. So Zoomies, Boston Beer, iRobot, and then I mean, there's just not many great companies out there that are, even if the market crashed by 50%, that they get even close to on sale, right? Is that what you're thinking?
Yeah, with a lot of names, that's definitely the case. One company that I would love to own is Sea Limited, which is, I guess you could say, the Southeast Asia version of Amazon, or Tencent probably is a better comparison.
Okay.
And they're growing at like exceptional rates, like 100% revenue growth each year. Like they're still in full growth mode, but they are very expensive. At some point, I would expect those multiples or the valuation to half from what it's worth at the moment. And then maybe you're at about fair value at the time. So if the market crashed and that got hit hard, that's when I would love to own. Exceptional company, exceptional management, a lot of growth to go. So that's one of the names I love, but it just sits on my watch list knowing that I'll probably never own it, but I would love to.
All right, Frank. Well, I want to talk to you more off the camera, off the podcast, because I do have a couple questions for you. But we've been recording for about an hour now, which is I didn't get something from Zoom, so thank God for that. But that'll do it, Frank. The last thing that you can do, man, is just plug your podcast, or not your podcast, your YouTube channel. Plug whatever.
Yeah, so my YouTube channel, I've just changed the name of in the last few days. It's now Frank Tabor, which is just my name. Previously, it was Investing with Frank, so I'm sure if you search that, it probably still pops up. I'm at Frank Investing on Twitter, or my username is Frank Tabor. Again, my normal name. You can find me there. They're the two places I do everything, so come check them out.
All right. That's it, guys. That was episode 38. Frank, thank you so much. I had a wonderful time. If you want to go follow us and watch these podcasts, go to Bearish Podcast on our YouTube. We have a shorts page as well at Bearish Podcast, or at Bearish Shorts. This podcast can be heard on Apple Podcasts and anywhere else, really. Go follow us on Instagram at Bearish Podcast. And that is it, guys. Thank you for watching and listening. We'll see you guys next episode.